Office hours. I'm Scott Fox. It's time to talk about startups. We're here this month again, as we do every month near the end of the month, to talk about early stage financing, especially to help early stage tech startups get a leg up in this very competitive world. The world is apparently awash with money, but it's still hard to get if you're an early stage entrepreneur, especially if you're pre-revenue or you haven't demonstrated the kind of traction that angel investors seem to demand these days. So today we're going to talk about that. Especially we're going to focus on term sheets, which is a particularly perplexing area for a lot of founders because the media covers the business from the VC's point of view usually, right? The venture capitalist point of view. So today I thought we'd talk about term sheets, particularly from the founder's point of view, to help as many of you as possible figure out how to get the best deal for the equity in your new company. With us, we're also going to have our good friend Joe Daniels from McCarter & English, which is a top-tier law firm in New York City. Joe has done literally billions of dollars of VC financings at all stages of the food chain and different industries. He's going to join me here in a minute for a few minutes to talk about term sheets, and we'll take some of your questions as well. Thanks to those of you who are tuning in. I see Abby and Seyi and some other folks. We'll get the chat going here as well. If you are... Let's see, let me play with my fancy control room here. If you are watching us on YouTube or LinkedIn or Facebook, you can chat, and the chats will start showing up next to my face here, over here, and we'll take some of your questions live that way as well. And if you want to appear on camera with me, here's the link for that. Happy to join you. It's always more fun when people, can see your face, right? And it makes more of an interesting and memorable show and education. I'm Scott Fox. I'm the CEO of the Startup Council. We're a community service group based in Southern California, but really with worldwide reach thanks to the internets. And my mission in life, at least at this point in my career, is to help as many early stage founders as possible get out there, get on the road, and build some great companies. I'm a serial internet entrepreneur, a very active angel investor, former attorney, an investment banker, a startup founder. So I've done all kinds of this stuff for many years, including writing these books behind me, which I didn't write them all. The three in the middle are English and the rest are foreign translations. So if you're tuning in from somewhere else in the world because you read the Russian or the Japanese or the Polish translation, welcome to you as well. We're here every month on the last Tuesday at noon Pacific time because that's lunchtime for me. So I'm sharing my lunch with you from my office here in Southern California. Okay, so let's get going. Let's see, you can join me on camera there. Let me just a little more housekeeping here. What else we got here? Oh, invite your friends. If anybody else wants to join, we're here on YouTube live and streaming there and taking questions there, like I said. So go ahead and use the chat to ask some questions, and we'll put them up on the screen and take those as well. Quick legal notes. This is being recorded and will be shared online. It also is not legal advice, although both Joe and I have law degrees. This is not official legal advice. We are preventing... This is not to be relied upon. You should consult your own counsel, which might include a smart guy like Joe. And what else? Oh, there it is. This is not qualified legal advice. There we go, in writing. Okay, so let's get going here. I'm going to invite my friend Joe on camera, and the rest of you who are nearby, like I said, hit the chats and make some friends with each other, and we'll get going here. We're going to talk about term sheets. So let's see if Joe's here. That looks like Joe there. Hey, Joe.
Hey, how's it going?
All right, good to see you. Let me get you up here so we can see a little bigger. Let's see. No, that's not good. How about that? Looks maybe. There we go. Hey, there he is. Okay, so this is Joe Daniels, everybody. Hey, Joe, good to see you.
Hey, how's it going?
Good. So here, let me put that up there in case any of you. Joe Daniels is a pretty easy name to spell, but there you go, in case it was a mystery to you. Okay, and he's with McCarter & English in New York City. So. We're going to talk about term sheets for a while. I know Joe has to run to a board meeting in 20 minutes or so, so we'll make this quick. And in the meantime, you guys can ask some questions along the way. Okay, so Joe, the reason for this today, and thanks for being here, by the way, it's nice to see you, is I was running a Masterminds group, as we do every month, and you've spoken at those actually, and I was talking about some term sheet points, and the room blew up, well, the virtual room. I mean, people were really intrigued by the things that a founder should negotiate, because it looks like most of the articles out there are a lot of the financial people talking to each other about how to get the best deal from a founder. But from a founder's point of view, there are things that they should watch out for, right? And so we were talking about like common versus preferred, or ratchet dilution sort of phrases, vesting for founders, I guess the reason this started, let me start with an easy one because I think you'll agree pretty quickly. This started because a founder I'm working with here, he got hit with a term sheet that had a bunch of fees in it. And there were two kinds of fees. And maybe you could start there and just tell us what kind of the industry point of view on this is. One was it had a $9,000 fee that he was supposed to pay them to pay for their due diligence, which I thought was a little odd, but I'd like to hear your opinion. And then there was another fee, which may be a little more legit, was a budget of another up to $90,000 to pay for their documentation, for their attorneys. And that would be paid not necessarily up front like the first $9,000, but would be paid from the proceeds that they were going to give him.
Mm-hmm.
What is this? This is the kind of
what
thing.
What was the size of the round in that deal?
It was $3 million.
Okay. So that's a typical larger seed round, or maybe even a small A round. The median A round is like 10 million these days, so maybe not an A round, more like a seed. So the 9,000 diligence fee is you very seldom see that. In fact, it strikes me that that might have been there are people who pretend to be able to write checks or to be institutional funding sources, but actually they're just creating an SPV and going out and raising the money once they have the term sheet with the founder or the company, and then they they don't have the money, they go out and try to raise it, and someone who adds in a $9,000 diligence fee sort of fits that personality type or characteristic, and the 90 grand is high for a seed round. I usually see that at between in the more expensive areas like New York and Palo Alto, 25 to 50K. So definitely twice the typical. SPV is a special purpose vehicle. In other words, they create a little LLC that they raise money into, and then they collect management and carried interest fees, almost like a small VC fund, just for your deal that they sign with you.
Right. Excellent. Okay, this is great. It's good to talk to you because that gave me an angle on this that I hadn't seen. So these folks might be essentially a blank check. These guys were looking to do a deal, but wanted the founder to pay for their research so they could go raise the money and create a job and an investment for them. That's kind of what you're saying.
That's right.
Interesting. Okay. That's an angle I hadn't considered. Okay. And this 90K, this was a New York firm, so I guess they thought they were really expensive. The punchline for anybody that's interested, including Joe, of course, is that I think these guys were actually kind of predatory, because as soon as the founder here wanted to start asking for references, they started demanding their $9,000. so that's you're raising your eyebrow.
It's a big red flag. Yeah.
It's what?
It's a big red flag when your investor starts asking you for money, right?
Yeah, exactly.
Especially up front.
Right. Okay, cool. All right. Well, that was a great place to start. Okay, so I realized in my excitement to see you and get going, and I know your time is valuable, I didn't let you introduce yourself. So now everybody knows you know what you're talking about. You proved there. You stumped me right away. So this is Joe Daniels. You want to talk a little bit about yourself, and then we'll get to more questions.
Yeah, so I'm a partner and co-chair at McCarter & English, and McCarter is a 175-year-old full-service law firm with startup to Fortune 50 clients. And we basically have a business for a department for everything a business needs, like corporate, intellectual property, litigation, real estate, and tax. And I'm in the corporate department. We have about 400 lawyers and 10 offices throughout North America. And we've been representing startup founders and investors forever, from Thomas Edison to more recently, his family's venture fund. And I'm the co-chair of the emerging company venture capital practice, which focuses on formation, financing, growth, and exit. So basically helping a company decide what type of company to form, how to structure the equity and protect the IP, raise money in successive angel and venture capital financing rounds, expand through acquisitions and partnerships and commercial agreements of every type, and then exit through an M&A deal or an IPO. We're usually ranked as high as the top 3 firms in our region, and have been as high as 6 and 9 nationally and globally in terms of the number of angel and VC deals that we close every quarter and every year in the pitch book. And for example, we've done about 180 deals now in 2021 year to date for about $8 billion. And we also have 120 IP lawyers that can help with virtually every scientific area, technology to life sciences, and 100 litigators ready to sue and defend companies all over the U.S., including California, for example. I've been doing this for 25 years. I've been, including 8 in California during the .com days. I basically joined the group that took Netscape public and sold it to AOL. And I've represented lots of big public companies like Polycom, which was acquired by Plantronics, and Autodesk, and Monster Worldwide, the job side, and Credit Suisse and Morgan Stanley on the underwriter side of IPOs. So work with a lot of investment bankers like yourself, and I've done 25 IPOs and follow-ons and scores of M&A deals and financings.
Well, there you go, folks. So this guy knows what he's talking about, and he's also a nice guy, which is rare in this world. So anyway, so thanks for being here again. Okay, so we answered Lulu's question already. Ken, we'll get to yours in a second. Let's talk a little bit, if you don't mind, about common versus preferred form. A lot of founders, I think, get confused that there are different kinds of stock. And I know this is pretty basic stuff, but can you just kind of, from a founder's point of view, what they should be?
I'll give you the sort of high level. So basically, preferred stock has a few extra rights as compared to common stock. And it was initially created to fuel the Silicon Valley for the purposes of being able to sell the preferred stock for cash at, let's say, $1 per share one day, and then grant stock options on common stock at a 70 to 80% discount, 20 to 30 cents the next day. So you're basically giving your new team members, after raising a $5 million round from Accel Partners, in the money options, which justifies them leaving their job at Hewlett Packard, making hundreds of thousands a year, to come on board and take a salary discount, and because there's that they're getting like a lot of money, quote unquote, on paper up front in that option, plus all the upside from there, right? So just so people know, that's the purpose of it. It's a tax-driven thing. And preferred stocks' principal different superior characteristics are liquidation preference, meaning they have a right to get 1x their money off the top, generally, of any exit before common stock gets any. And they're also blocking rights, like a majority of the preferred have to, just making it simple, have to approve major corporate actions like selling the company, dividend, repurchase of stock, increasing the size of the board. And they're often information rights and board seat rights and other things attached to preferred stock. Right.
So that's where it starts to get complicated and confusing for founders, for sure. Can you talk a little bit more about liquidation preferences? That's an eye opener to a lot of founders, that somebody can get more than what they put in out of the deal, and they get paid before you get paid, right? Even as a founder?
Yeah, I mean, the concept is that's only when it's a down round scenario. Like, for example, let's say that you raised $2 million on an $8 million pre-money, and then the company sold for $4 million. Then the preferred stock would be able to get $2 million out of that $4 million, leaving only $2 million for common. If it's only sold for $2 million, then common gets zero, preferred gets everything, right? It's sort of a downside protection. And then, of course, if the company is sold for $100 million, they're not going to want just the preferred's not going to want just their $2 million back. They're going to want the as converted amount. Preferred usually converts 1 for 1, so they take their 20% or $20 million.
Yeah, well, there you go. So, and the important point there is that that's in a down scenario, right? So founders can get freaked out because, like the investor puts in $1 million, they get back their money and more than that, maybe, if things go poorly. But the idea is to align your incentives so the company grows together and everybody makes a lot more. And that doesn't really, the liquidation preferences are really only in a liquidation scenario, right? It's when things go badly, right?
Right.
Yeah.
Not just the liquidation, but also, a sale of the company at a low price.
Right. Sorry. Yeah, exactly. Yeah. So that's the point I'm trying to make, guys, is that this is, if things aren't going well, yeah, they're going to claw their money back. Just kind of like, I don't know, if you took out a loan for a car, they'll take the car back, right? What if you fail to make your payments, that kind of situation. But if things go well, and the whole point of that is that things go well, and then things are exciting, and everybody makes extra money. Okay.
Yep.
So what about Joe, the stock options, and what are the current standards for founder? Not for the founder, but for the pool for the founders and the early team. The idea is that people set aside a chunk of stock so that, and investors want to see this sometimes too, right? They set aside a bunch of stock for the founders, but also for early hires. Can you talk a little bit about that and how much is current these days?
Yeah, you hear a lot of talk about equity pools or equity plans, option plans, and simply put, you generally don't need that until you do a priced equity round, because that's when you need to go out and get because of the tax issues, you can no longer give people restricted stock. So in short, prior to the priced equity round, you can. There's a cat like right in front of me here because it's just. This is a perfect time to come in front of my keyboard.
So yes, we need to get its own webcam.
I mean, short answer is we usually issue restricted stock even after selling notes and safes in a startup at close to zero to incentivize not only founders but also people who are joining after the founders. Mm-hmm. But before the priced equity round, and then you create that equity plan and you grant options after that. It's usually 10% to 15% of the fully diluted outstanding.
Okay. So Lulu, this basic question, a priced equity round is basically a lot of money is raised early on based on a we'll figure it out later basis, a convertible note or a safe type thing, which you're not sure what the company's worth. So Joe's saying when the first time you actually set the price for the company, it's going to be 5 million or 10 million or whatever it is. That's when all of the convertible notes convert, and you want to lock all that stuff down, including the option pool that he was just talking about. Is that a fair characterization, Joe?
Exactly right. Yeah.
Okay. Okay, cool. You're watching the Startup Fundraising Office Hours. I'm Scott Fox, and we do this once a month to try to help early stage founders. Our guest today is Joe Daniels from McCarter and English in New York City. He's sharing some of his insights after working with many, many startups at the early stage. If you have questions and you want to type them in the chat room, we'll start doing those. And let me put the on-camera link as well. If you'd like to join us on camera, I'd be happy to have you come on and talk to us directly as well. Let's try going to Savas here. Savas says, I'm a founder at Shop Local. My product is at the market. We're starting to get customers. Company has 100% mine, and I would like to give some stock to my managing team. What is your suggestion? Okay, so early, this is right on target, Savas. Thank you for participating. So what kind of incentive program would you suggest there, Joe? What's typical?
Some stock to my managing team, huh? So, I mean, it depends on what roles are each of those people going to play. I would generally recommend that before the first price equity round, you're still keeping about 70% of the company. So that leaves 30% that you could give to co-founders and other people joining. Most people will get less than 10% when they join, but it depends. It depends on basically the stage of where the startup's at, which means you'd give people in the earlier stages more, later stages less, and the skill set and experience level of the person joining, and the amount of time they're going to work, whether it's full-time, part-time, or an advisor, a couple of times a month.
Yeah, and this is a constant. It's a good question because it's a constantly moving target. Like Joe said, there's a lot of variables there, right? But in the last few years, there have emerged standards for this kind of thing. So you could look around, do a little Googling, and find some articles. I think Savas would at least give you some ballparks about, are you talking about 2% or 20%? Because depending on where you are in this process, you might not even have an idea, right, of the range. And the trick is always to balance that against that person's expectations, because a lot of people think that they can work with you for 3 weeks and they should own half the company, right? So this is as much psychological as it is legal. It's a negotiation, basically. Lulu says, is that percentage of the founder's position or of the company? This is a common misconception. Companies don't start with a limited number of shares and then they reapportion them as they go. They issue more shares along the way. So if you have 1 million shares to start and a company comes in and invests, you will issue them more shares. So you might have 1.5 million or 2 million after that transaction. And then another investor comes in, you issue more shares. So it dilutes you. It doesn't replace or take the shares that a founder has. That's a big thing. I even struggled with that back when I raised my first round. Okay, let's see. Randy, let's try Randy here. What would you suggest on the term sheets to issue as a startup for $200,000 seed money when looking forward at the next round of 2 million? Also the term sheet for 2 million. Okay, we're gonna have to figure out what he means there, Joe. What would you suggest on the term sheets to issue? So you're a founder, you want to raise 200,000. What should you ask for in your term sheet, knowing that you're going to have another round of 2 million coming? I think that's what he's saying. Sorry, there's a clarification. Founder has 10 million common shares and pre-money for $2 million round is 10 million. Okay, so we've got some math there. Can you do that on the fly, Joe?
Yeah, if I can find it. I don't know what you're reading there.
Okay,
Is it?
sorry, maybe you can't see the chat. Okay, let me restate that. Randy is asking about issuing a $200,000. He wants to raise $200,000, and then he wants to raise $2 million later at 10 million.
Okay.
So he's asking, what should his $200,000 initial seed money term sheet look like? Okay.
Right.
So that's a pretty general
So this
question.
is like with that amount of money and everything. It depends on where the company's at, but usually you would sell a safe in the Bay Area, New York, Boston, in the tech centers of the world, because that's just the instrument that investors are most accustomed to investing in at that stage, and it's a good deal for the company. And a safe is a simple agreement for future equity that converts into the next equity round, either at a discount, the lower the round price or the cap, or both. And I'd always recommend discount only or cap only. $2 million for 20%. What is that question? Is that a statement?
I think he's clarifying. Yeah.
Okay.
He's saying it was a 10 million pre, so 2 million in that second round he's talking about.
Oh, yeah. 2 million for 20% is 218, right? So 10 million post. So for example, you'd want to set the safe, or the investors would want the safe if you're really planning on this, and that's what your story makes it sound like you're actually going to do. Then they would obviously want their cap to be less than 8 million, right? It would, depending upon how far away that $2 million raise is, maybe it would make sense for the cap to be 5 million, right? But you'd have to give me all the facts. 12 million post, that's not 20%. 2 over 12 is not 20%, right? It's 16.67.
Right. Okay. So, 12 million posts. That's right, Randy. Exactly. Okay. Joe, you've got to go in just a couple minutes here, right? Is that still operative at 12:30?
Yeah.
Okay. Okay. So we'll probably do one more question. And Joe is reachable, obviously. What's the best way to reach you, Joe? Do you want them
Probably just jdaniels@mccarter.com, my email. Yep.
jdaniels@mccarter.com. There you go. Okay, Sasha here has a question. When private equity invests in a down round, under what circumstances could common shareholders be wiped out? When private equity invests in a down round, under what circumstances could common holders be wiped out? There's lots of circumstances.
Yeah, I mean, it just depends on how low the valuation is. If you issue enough stock, like Scott was talking about, this concept of a corporation, you can always authorize more shares and issue more shares. So if you start out with 1 million shares and the company issues 500 million shares, your percentage goes way down. And in order to raise more money at a really low valuation, you have to issue more shares. So.
Yeah, that's right. So it's a dilution question and a valuation question. So they're moving targets. But if your value goes down and you've issued a bunch of shares to other people, you're going to get wiped out. That's the simple version.
Yep.
But that can take a lot of spreadsheets and cap tables to prove that.
People should be thinking positive. The liquidation preference will never matter, and there'll never be a down round.
Right. That's the opportunity for sure.
And that seems to be what's happening in the past 3 years, and it might continue for a few more.
There you go. Okay.
And then it'll go the other way.
Right. Yeah, and what he's referencing there is there are trends in financing, right? So it's good to keep up with folks and have a good attorney, right, who can track on this stuff, because if you're talking, I say to people all the time, you wouldn't have, a ear, nose, and throat doctor operate on your ankle, right? It's the same thing with lawyers. You don't have a divorce lawyer do your venture capital, right? These are specialists, and you can tell by the way Joe talks, he knows a lot about this stuff, and it's in your best interests. They're not cheap, but it's in your best interest in the long run to have a professional on your side who does this all the time. Okay, just a couple more points before I know you have to run. Could you say a little bit about founder vesting and what's typical now? Because a lot of early stage founders are surprised that sometimes they have to vest in their own company when they thought they owned the thing already.
Yeah, I mean, I always say all founders really want all the other founders to vest, because if one of the founders leaves, and let's say you split the equity three ways and one founder leaves after 2 months, that founder should no longer have 1/3 of the equity. And that's what vesting schedules or help you achieve is fairness. And so therefore, like the typical founder vesting schedule historically in the Valley has been 3-year, 1-year cliff, meaning 1/3 after 1 year and 1/36 each month after that. And that usually starts from whenever the person actually started contributing to the company. So it can be a year or two before the date that you actually do the agreement that says all this, right? If you're concerned about losing your shares, getting fired and losing your shares, just try to retain control of the company as a founder. The typical for people who join after the founder is a 4-year, 1-year cliff, the same thing except an extra year. And for advisors and directors, 2 years monthly. Just some basic guide. These are standard schedules all throughout the United States at this point.
Yeah, and that's the great thing. There are standards now. So a lot of times, folks, if you're trying to figure out what you should do, you really can just Google it. That doesn't mean you should try to do the whole thing by yourself, but some of these awkward conversations with founders and early team members, there really are standards out there that you can point at. And Seyi is going to come on after Joe leaves. He has a question about this. We'll talk a bit more about advisors and how to compensate them, that kind of stuff, because it's the similar answers, but a little more specific for advisor situations. So,
okay, I've got to sign off, unfortunately, but it's great to see everybody, and just let me know if you have any questions.
Awesome. Joe, do your email one more time.
jdaniels@mccarter.com.
jdaniels@mccarter.com. Great, Joe. Thanks. Nice to see you.
See you later.
Good luck in your board meeting. Okay, folks, so that is my friend Joe. And thanks to him for his time. McCarter English is a good firm. There are lots of good firms. It's one of the things that we can do here. If you're looking for a law firm, I know lots of law firms. You can reach out to me through scottfox.com. I can't do a lot of coaching. I get lots of people want me to review their decks and so forth. I can't do all that, but I can easily pass you along if you're looking for accountants or attorneys or recruiters or tech shops to do development, that kind of referrals we can do easily. My assistant can do those basically. So we got another half hour here on Startup Office Hour, and I'm Scott Fox. I'm your host. I'm a serial internet entrepreneur here to help you learn the ropes of how to raise money, basically. So I used to be a founder. I still am a founder, I guess, but I've raised money myself, and now I'm more of an investor. So I've done this on both sides of the coin. I'm very active with Tech Coast Angels, which is the largest angel group in America. They're based here in Southern California. I'm also the chairman of the Stanford Angels and Entrepreneurs group here in Orange County, California. And I'm trying to help you guys out, basically. So if that's helpful to you, please. I'm doing this for free during my lunch hour, like I said. So would love it if you could like or share this stuff, invite your friends, subscribe, all those social things. Where's that? There it is. That. Okay, could you do that, please? Trying to help you out here. And that's how the social media world works, right? Okay, so we're going to bring on Seyi. I'm not sure I'm saying his name right, but we'll find out, I guess. Let's see, here we go. There he is. Hello, Seyi.
Hi, how are you?
Hey, good. Nice to meet you. And I can hear you perfectly. That's always everybody's first question. So there we go. Nice to meet you. And hi, is it Seyi? Is that close enough?
Very close. Seyi.
Oh, it's a Shea. Okay, Shea. Okay. All right. Nice to meet you, Shea. So why don't you outline for everybody your question, and I'll see what I can do to help you.
Sure.
Oh, so I'm sorry. I do this every time. I remember what else I'm supposed to say. Everybody in the chat room, go ahead, put in your questions now, and we'll work our way through them. Also, I encourage you all to introduce yourselves to each other. Go find each other on LinkedIn. Let's build a community here, right? And you're welcome to find me on LinkedIn as well. I've got where is it there? Come and connect, and the idea here is we're building a community because it's a lot easier to build good companies if you have friends, okay? Like most things. So, all right, back to Shea. Sorry to cut you off there, Shea.
No worries. Yeah, so I was approached by someone that saw my startup, so the app that we had built, and that realized that we haven't essentially raised money, that been bootstrapping for a while. And so his offer was that he can come in as my financial advisor to help take my company from pre-seed stage through Series A, and essentially make the necessary introductions to VCs, angels, syndicates, and whatnot to raise funding. Now, my question now is that is it advisable? Because I know right now the startup market is hot, the venture market is hot. People are investing in a lot of things, and so is that really just a person that sees an opportunity and is kind of wants to jump on it and get a percentage of the company, or do you think as a first-time founder, I actually do need that type of person?
It's a great question, and it happens all the time. And of course, the answer is it depends, right? Can you, first of all, where are you calling from?
Washington, D.C.
In DC. Okay, great. And are you a tech person or are you
Uh,
a finance person or?
yeah, it's text. So it's a tech story, social storytelling startup.
Okay, and you're on the tech side of that startup.
Yes.
Okay, okay. So I've been on both sides of that question also. You have a child there with you? Sounds like a little person.
Yeah, she wants to go to the bathroom.
Okay, okay.
So, but yeah, I'll turn off my camera and put it on speaker.
Okay, go ahead. No problem. You can take her to the bathroom too. Yeah, go ahead. It's the first time we've been interrupted by something that urgent.
Listening though.
You're still listening. Okay. That's awesome. Work from home. Joe had a cat. You've got a little girl that needs to pee. Excellent. Okay. So if other people are interested in this advisor question, this is a very common one. Like I said, I've been on both sides of this. I have hired advisors and I've been an advisor many times. So you are right to wonder, is this person trying to essentially take advantage of a good situation? Very likely. I mean, it happens a lot, right? They see you need help, meeting people that they know, especially in this example, as often happens, you're sort of techie and there may be a financial person, very common situation. And there isn't necessarily any bad intent here, but it often is a question of taking advantage. Yes. So you do need to be careful. The first thing I would do is ask for references. If you can do that, do not be blinded by people's promises of who they know. I've seen this so many times. I know this person and I know this prince who invests in everything, right? And you just got to be careful about that. So that's just kind of general business common sense. Like use your common sense. Right? If it seems too good to be true, it probably is. And okay, it looks like he's back. Are you back, Seyi?
Yes, I am.
Okay, let's.
There you go.
There he is. Okay. Hope everything worked out there. Did you hear that other part?
Yes, I did.
Okay, cool. Okay, so yeah, so be careful first of all. Then second, like the other question we were talking about with stock options and so forth, there are standards for this on the internet now. There's a fantastic resource called the FAST, which is FAST, something advisor services template. I don't know what the Founders Institute, maybe. Anyway, if you Google FAST advisor agreement, there is a template out there that is really useful because it breaks down. It's a matrix. It has 3 levels of involvement from the advisor, and then 3 levels of how advanced your startup is. Right. So if they're doing a lot in your early stage, they get more. If they're doing just a little bit and you're already half grown, then they get less. That kind of thing. Right. So you can kind of talk to the person and triangulate, what seems appropriate for them. And it gives you a rational reason for saying, no, I'm not going to give you 10% of the company for that, right? And also, most importantly, it introduces the concept of vesting, which Joe and I talked about a couple minutes ago, which is that people don't get everything at once. They get it over time. And especially in this case, it would be more about milestones. You don't want to just vest over time and have this person, taking up your time talking about what they're going to do. You want them to actually do something. So you want to pick out a couple key milestones that are, this kind of introduction or this kind of success or that kind of success before they get anything, right? Because otherwise they're just taking up your time, which is honestly your most valuable asset right now. If you don't have the money, it's your time and your brain. Now a big caveat on that. Thank you, Lulu, in the chat room there. Good job. There's the FAST link. That's a very useful template. I've used it myself. So the caveat I wanted to add to all that is that if what they're trying to do or claiming that they're going to do is raise money for you in exchange for equity, that's actually illegal. That is against the securities laws, unless they're a licensed broker dealer, like they do this professionally and they have licenses from essentially the SEC. Now, I haven't looked at this law lately. There's been some liberalization of that, I think, with the new crowdfunding laws, or maybe other things have changed. So you might want to talk to somebody, or at least look around heavily, like at the Founders Institute, and see what the latest laws are. But traditionally, that was actually a no-no, right? Because it's securities for getting paid on a contingent basis for raising money is actually the domain of a lot of scammers, right? People pump and dump schemes with publicly traded stocks and that kind of stuff. So there's literally laws against that.
I see.
Is anybody going to get arrested and sent to prison for that? If they help you raise 50 grand from the guy that they play golf with, probably not, right? But still, you should know. And if the person who's pitching you this advisory relationship is pitching that kind of relationship, they need to be aware of that. And if they're not, then you may not want to work with them. And if they are, hopefully they're licensed. And if they are and they aren't licensed, then run away.
Understood. Yeah, and I think. Oh, sorry.
Right.
Wait. Yeah, no, the offer was not, I guess, was to help me do what needs to be done, right? Work through my pitch, help create a VC playbook, the list of people I can pitch to, and really just walk through that process of bringing the startup to market. Now, of course, I started doing that myself, and I'm realizing it's something I can do, right? Of course, taking a lot of my time, but I'm realizing it's something that I can do. But it's not necessarily equity in exchange for raising money per se. Yeah.
Okay, that's fine. Compensating, and this is Lulu's question as well about building an advisor team. That's totally fine and done all the time. This FAST template will help you. It'll give you some ranges and help you give you some categories, like I said, to think about how much they're doing over what amount of time. And I think that may be the answer to your question, actually.
Got it.
I would just be careful, just one last point, I'd be a little careful about giving away money for some of those services, because a lot of them are available basically for free online. You don't necessarily need to give people equity for that. You do if you want to build a team, like Lulu was talking about. If you want to have people that are really on your side, committed to this, yes, then you probably want to get them involved. But there's a whole layer of services now that didn't exist when I was first starting companies. The small business development corporations have offices all around the country. There's got to be stuff, the SBDC there. The Founders Institute that I just mentioned. I run these groups, and I run my masterminds once a month also. There's lots of places where you can get coaching. So I'd be hesitant to give away too much of your company just for advice, right? You want to give equity away for people that are actually going to do the work.
Right.
Advice. Okay, glad you agree.
Yeah. So one final part to this question that I apologize for that. One final part to this question that I was wondering is, I was thinking of making the vesting milestone based, that at the Series A, you need to bring through the people you introduce me to or through the work you do, you need to bring at least 50% of what I'm trying to raise at the Series A stage, or at the pre-seed stage or the seed stage, rather than just saying that we raise money by this time.
I didn't quite follow. You want to add a
Sure.
milestone that they don't get paid until you raise the money? Is that what?
Yeah. So, for example, assuming I'm looking to raise 200,000 at the pre-seed stage, right? They need to bring through their networks and the work they do at least 50% of that money. But then, based on what you're saying, it almost sounds like that goes back to the side that you mentioned might be illegal, and so I'm not sure if it is. Well, I wasn't clear on that.
Yeah, well, it depends. I can't give you a clear answer, but yes, if you are compensating people being based on them raising the money, I'm pretty sure that's not allowed. If you're compensating them saying, I will pay you later when I raise the money, like basically like a deferred salary, but paid in equity, right? Like when we raise $1 million, I'm going to give you this. And their compensation is not connected to them raising the money directly, I think that's better. But you're getting into murky waters there. But that latter part is, to my mind at least, again, not legal advice. You should talk to somebody who does this for a living. But that's fairly typical, right? Like people all the time join a startup and say, I'll work for free until we raise some money and then you pay me, right? In cash, that's fine. It's just a little more complicated when you get into equities, because that's securities law, which is a lot of history of ups and downs and scams and stuff over the decades. So it just gets a little fancier very quickly. And then you also have the question of what kind of stock is it? Is it options? Is it restricted stock? Is it common stock? Is it preferred stock? It gets fancy fast. But
Right.
anyway, I hope that's helpful.
Yeah, very much so. Thank you very much.
Okay. Yeah, nice to meet you. Hope to
Nice
see you
to
again.
meet you.
Hope your daughter's taking care of business. Okay. So, all right. So that was our friend Seyi. Messed that up, I'm sure. Okay, Abby, looks like Abby's in line there. Abby, you want to turn on your camera? If you want to join me on camera, anybody else would like to come on? Yes, Gregory, you can ask questions here. Okay, there's Abby. So Abby's going to come in a second here. Let's just check the chat room for a second, Abby. Let's see. And by the way, thanks everybody for watching. If you could click the like and share buttons, appreciate that so we can keep doing this. Let's see. Sorry, I'm just reading here. Okay, let's see. Okay, Athena, we'll get to you in a second, especially if you have your camera on. Happy to see you. Let's talk to Abby. Here comes Abby. There she is. Hi, Abby. I think you're muted. Let's try that again. Oh, you know what? That's my fault.
Okay.
That was just a you're paying attention. Sorry, I had you muted. Okay.
Oh, okay.
All right.
Sorry.
Nice to meet you. And where are you tuning in from today?
I'm in New York, and I have a very specific question. You had mentioned that you sometimes recommend people, and we are actually we've done some financial modeling, just for what our capabilities are for a DTC home hygiene business with a go-to-market strategy that is hybrid, specialty wholesale and DTC with the subscription sort of follow on. And so it's kind of standard in the industry. Like when we're talking to folks for fundraising, like they get it, but I don't think our numbers tell that story. And we're probably at the stage where we need to work with someone to do that. And obviously we're raising money. So we're interested in maybe working with somebody, for percentage on the cap table. And, if they'd be willing to have some sort of, financial advisor, but it's very specific. Like it's a very specific model we need.
Mm-hmm. Okay, so you're talking about an advisor, basically what Seyi was talking about, right? Somebody to help you kind of commercialize and take it to market. In this case, the market being investors, not the customers.
Yes, it is definitely the market is the audience is the investors, but we do need a financial model that is just better than what we're working with. Ours is not very sophisticated. We have some benchmarks that we've kind of like industry standards that we've based it on, but it's not integrated. And because it's a hybrid model, it's a little bit complicated, I think, to tell the story.
Sure.
So we need.
And what is, without being too specific, what is the product? It's a beauty thing,
it's home hygiene, so it's cleaning products.
Cleaning products. Okay.
Mm-hmm.
Like a spray or something, like household cleaning, you mean?
Sure. It's dish soap. Right now, because we're doing our, MVP. So we're starting with dish soap, all-purpose cleaner, mirror and glass cleaner. And we also have a hand soap. And so it comes, sort of in a kit to get started. We'll have add-ons later. We're going to do, wipes, dishwasher, and then laundry in future. And then we have a scented gift that is actually, fairly high value, but we're kind of capitalizing on some of the interest in home scent right now.
Okay.
In the product. We're also working with a really cool NASA biomimetic botanicals. So that's a fun part. Yeah.
Okay. So good news, bad news. I guess bad news is I don't know. I'm a software guy.
Okay.
So, I don't know much about direct to consumer stuff, but good news, I do know a firm you're in New York City?
Yeah.
I know a firm in LA anyway that does financials for a lot of direct consumer companies, an accounting firm basically, and they help them with modeling and financial modeling and even term sheet negotiations and stuff. So cool. I would I'll just say this publicly, I'll give them an endorsement as far as I know. I'm pretty sure they're called Stage 1 Financial, stage with the number 1, usually not spelled out O-N-E, although I might be wrong about that. And the lead guy there, who I've worked with some, is Jeremy Triefenbach, I think, something like that. You can take your best guess at that, Triefenbach. But Jeremy has worked, there's a company I'm involved with that is a direct-to-consumer company, which is very unusual for me. That's why this is the only contact I have. And they've been working on their financials. And they seem to be pretty sharp, and they're direct to consumer. So you'd be welcome to contact Jeremy, use my name if that's helpful, and don't necessarily ask them to do something, but maybe ask for recommendations, so forth, that kind of thing. And that might be useful. The other is that there's a venture competition that I've seen a bunch of times lately that's actually European based. That's a direct to consumer venture pitch type thing. And I can't remember the name of that offhand. I did pretty well there with stage one, but the venture one,
it's not the Founders Factory, is it?
That does sound right. Maybe that's it. Does that sound right? Is it based in Europe or something?
It's based in London. They do a lot of DTC. We actually did an initial meeting with them because their accelerator for hygiene is run by Reckitt, and Reckitt was interested in maybe doing some testing on the botanicals.
That's probably it then. Okay, yeah. All right, so you know that one. Okay, that's the limit of my knowledge there. If you're a software company, I could help you a little more. But anyway, that might be a good lead, and I hope that's helpful.
Very helpful. Thank you.
Okay, great. Nice to meet you. Hope to see you next time. Please like and subscribe and all that stuff, right?
Okay.
All right, cheers. Okay, so that's our friend Abby from New York City. Let's see. Next, hey, Athena, do you have a camera? I'd be happy to see you. I know you own one because I've seen you at some of our Masterminds meetings. Speaking of that, our Masterminds meetings happen once a month. Those are, they tend to be the second Wednesday or Thursday every month. And traditionally they were face-to-face here in California, but now they're online, of course. So if you like this kind of environment, but you all want to talk to each other more, it's like this, but 30 or 40 of us all online, and I moderate. Same deal. You guys bring questions and we discuss them. Sometimes we have guest speakers. We also do investor pitch practices. So if you want to practice your pitch, you can get tickets for those, as you can see on the screen there, at mastermindsworkshops.com. And it's free if you bring a question. So kind of like this, but it's a little more interactive, and those are 2.5 hours long usually. So a little more networking, a little more fun, and a lot more in depth. So okay. So Athena's driving, so no, good. Okay, no, that's fine. And Gregory, yes, you can post your question in the chat there if you'd like. Let's see. Let's get into Athena's thing. Oh, hold on. I saw another one, Athena. If you're driving, let me just review the chat here because I know the questions were coming quickly. Okay, took care of that. Randy and then Savas. Let's see. Oh, Lulu. So I see one there I missed. Will you speak to the differences between giving key team members a percentage for C Corps versus LLCs? So C Corp is a standard corporation, and LLC, limited liability company. Those are both corporate formations that a person can use to create a company and protect themselves from liability and grow, basically, as a company, as opposed to just something that you own by yourself. For venture type funding, Lulu, the answer is very easy here. You don't do LLCs, full stop. Investors do not invest in LLCs. Venture investors do not invest in LLCs. Your uncle might, right, or your aunt, or the local bank might. But venture investors only invest in C corporations. And these days that is standardized around Delaware C corporations. So corporations that are incorporated in Delaware as a C corp is the standard. And that is new in the last few years. Before you could maybe do California or maybe some other places. But these days it's a Delaware C corp, full stop. So that kind of, not the answer you were expecting maybe, but that's how it works. And then Richard, so yeah, this is one I saw. So for a pre-revenue raise, how much equity in percentage should be given for each million in capital, assuming the TAM is 500 billion? Okay, that's a big market, Richard. For a pre-revenue raise, should be given for each million in capital. So, okay, you're talking about valuation. So the 500 billion total addressable market, that's what TAM stands for, folks. Total addressable market, meaning everybody that possibly could think of that might be a customer of yours. This is a $500 billion market. So Richard's targeting something huge like air or water or food, or gasoline or something really large. So how much percentage should you give for each $1 million in capital? Well, it's not a question of the TAM. There's 3 levels that VCs look at when they're analyzing a company. That's total addressable market is the TAM. The serviceable addressable market, SAM, is how many of those $500 billion are available that you might actually reach. So not like all the food for everybody in the world, but the food for people in, say, the United States, right? Because that's how you could practically, realistically reach. And then the SOM, S-O-M, serviceable, obtainable market, which is the people that you really will reach. So not the food for the planet or the continent, but just say in your state. So you're in Ohio, the food for everybody in Ohio, right? So TAM, SAM, SOM. And the SOM is what you're actually going to deliver. So the TAM is exciting because it's really big, and that's a very good thing, but it doesn't tell you anything about the valuation or how much capital how much equity one would get for capital. So $1 million, I don't know. What does your market actually look like? Not what could it look like, but what does it actually look like? How many customers do you actually have? What kind of revenue are they generating over what period of time? What does it cost you to acquire those customers? Those are the kind of numbers you need to then work backwards to say something like, we're doing this much revenue a month, or we have these kind of customers. It costs us this much to acquire those customers. There's this kind of churn in the customers if they're repeat customers. And that means that we have a valuation of $8 million or something like that, right? You need to work backwards. And the TAM is the right idea, but that's too big. That's the theoretical market. You need to get a little more to the actual market. So I hope that's helpful. Let's see. Okay, Athena, we are getting to you. Lulu's just chiming in here. We choose LLCs. We don't want VC and are going for PE, meaning private equity. My understanding from my legal team and our investors that we can do angel and PE funding as an LLC. We don't want to, I presume you're missing a verb there. We don't to avoid VC funding as tech angels invest in LLCs. No, I don't know of any deals, at least these days, ever, maybe, right? Anything's possible. There might be exceptions to the rule, but the standard is Delaware C Corps, full stop, for venture capital money. I don't know about private equity because private equity really means buying out existing businesses. So if an existing business is doing well and they're structured as an LLC, you're talking about an already operating company and they're buying based on revenues for an existing company, right? So if you've got a company that's spinning off millions of dollars a year in cash, they're not going to care whether it's an LLC or a sole proprietorship or whatever, right? Because they already have proven the model based on revenues and profits, presumably, or losses, right? Depending on what they're looking at. But for a VC type investment, these days it's a Delaware C Corp. So you might want to ask your investor why they think that. Again, I'm not the world's only expert on this. There's lots and lots of people. And you should find a good attorney and so forth, or Lulu, keep coming to our Masterminds meetings, right? Let's see. Okay, now we're going to get to Athena, I promise. Let's see. Let me just put that other caption back on the screen. No, not that one. Where is it? I wanted to promote the Masterminds workshop. Sorry, hold on. There it is. Okay. Okay. So Athena had a great question. And she said that she's having trouble shifting gears. She's a solopreneur, funding her own businesses. She's a serial entrepreneur. So she started a few businesses of her own and funded them herself. And now she's having to go out and brave the world of raising money with investors. So she's read all the good books about raising capital, and she knows the technical side of it. Any advice where to start? Where to start raising money? Well, you start right here. That's why I do this. So I hope this is helpful. And you come to our Masterminds meetings already. So let's practice your pitch. That's what it boils down to, because I think I recognize and respect what you're saying. It's a different thing when you work for yourself. It's the difference between being a bachelor or a bachelorette and being married, right? Suddenly there's these other people involved, and then having kids, essentially, right? Because you've got investors who expect things from you, and a board of advisors and a board of directors who actually are your boss if you're a founder, and especially if they give you enough money to control the company. You're working for somebody else, and you need to be ready for that. And it is a big shift mentally. But the way to get there is like anything else, just like learning a language, right? You learn one word at a time and then you practice, right? So, and ideally you go spend time in that country so that you're forced to speak that language. And that's what you need to do. And so I would look at pitch templates. It's a lot about the pitch deck these days. Luckily, we've evolved past the point you don't need to write a great big business plan anymore like I used to write back in the 90s, big plan with 5-year projections and stuff. You can really just look at trying to get your mindset right and a deck of 10 or 15 slides at most, and try to present the problem, the quick approach here, really, we can do a whole session on pitch decks. Actually, if you guys are listening, I'd love to hear what else you'd like to hear about. If you want to chime in the chat room, I'd appreciate that, because I noticed we got a lot of signups this time when I talked about term sheets specifically, and it seems like a lot of people are very interested in that. So give me some ideas for other specific topics you'd like, and I'll try to address them. But the quick version on pitch decks is problem solution framework. You have to resist the temptation to talk about your product all the time, because as a founder, you're in love with your product, right? And every little feature is near and dear to your heart. But honestly, investors aren't that interested in that. They want to know about the business, right? And you don't have a business unless you have customers. And you don't have customers unless you're solving a problem. So I would think about your pitch deck in terms of what is the problem I'm solving and why, and then how big a business is that going to be and when. That's really what a pitch deck is. And it doesn't have to say everything. It's really just kind of the first date. You need to present enough to get people interested that they want to hear more. And then you can have the meeting and really, talk it over lunch, and so forth, and get into longer projections. But a pitch deck is really a calling card that lets people know what you're about and why and what the potential is. And ideally, these days, you kind of have to have some actual sales. You used to be able to raise money more easily just on more on concepts or pre-revenue prototypes and minimum viable products. But these days, investors really are looking for traction, which means cash, means customers are buying, right? So Athena, love to see you here. Love to see you at other events. Actually, I'm speaking tomorrow night. If you don't know about this, I'll give you free tickets since I know you're local at Concordia University. I'm on a panel. It'll be a very interesting panel. I don't think they're Zooming it, the rest of you, sorry. But it's a panel of, it's me as an angel investor, a friend who runs a venture fund, and another gentleman who runs a family office, moderated by another investor friend. And we're talking about the differences in investing styles and requirements when you pitch family offices versus VCs versus angels, right? And that's at Concordia University tomorrow night in Irvine, California. Athena, I've got a comp code if you want to go. So the question of how to shift your mindset is practice, but it's around those two things. It's the deck and your pitch, the story that goes with the deck. And if you rehearse those enough times and do it in front of other people, not just in front of a mirror and not just to your mom, then I think you'll get where you need to be. And as you know, I'm happy to help, and we have lots of resources to help you do that. Okay, so there we go. It's 1 o'clock already. Look at that. Okay, well, so I think we're going to wrap up. But let me just check here, see if anybody has other questions. Oh, I didn't know I could do that. Look at that. I just featured your question, Greg. Cool. I don't know. Hold on. This tool. Okay, cool. All right. Well, I just learned something with Greg. I got to put that on the. Sorry, I'm going to try that again. No, that didn't do it. I don't know how I did that. All right, I'll practice that offline when the rest of you aren't watching me. But I'm Scott Fox, and you have been listening to the Masterminds Startup Fundraising Office Hours. This is a free service from me. I run the Startup Council, which is an organization dedicated to helping folks just like you get to, well, kind of to where I am. I'm mostly an investor these days, trying to help, and happy to help you here or in the Masterminds workshops that I mentioned. And if you do have a chance, would really appreciate you liking and subscribing. Because, if I only have 10 people watch this, then it's not worth my time, honestly. And I need your help to get the word out there, because I'm not making any money here. So it would be nice to get the feedback. So, okay, so that's my pitch. Let's just review the chat here before I hang up. Let's see here. Okay, so got that. Thank you. Yeah. Yes, you guys can hit me on LinkedIn if you'd like. Let me post that again while I'm just reviewing the chat. Happy to connect. Like I said, I don't do LinkedIn messaging though. I get too many of those, just so you know. I really am happy to help, but email is the way I work. You can go to scottfox.com and find a contact page for me there. Oh, and this is the Startup Council page on LinkedIn. I would love to know if folks where you are streaming. So send me feedback about that. Hopefully that's going well. And sorry, I am trying to wrap up here. Okay, that we covered that. We got that. Okay, for what it's worth, Kirk, I've never heard of a run book either, Lulu. I don't know who your investor guy is, but if he's telling you you can run an LLC and use something called a run book. I'm not sure what that advice is based on. I've never heard either of those as good advice. So hopefully hope that's helpful. Okay. Chris, great question. Probably more than we have time to go into today. Happy to talk to you next time, or come to our Masterminds workshop to talk about how to get from self-funded MVP to raising money. That's what we talk about pretty much all the time on this show and the Masterminds. And thank you for being here. Lulu, you're welcome, Lulu and Abby and Athena and Heather and Chris and Kirk and Chris and the polyester giant. You're welcome too. All right, guys, nice to meet you all. Hope to see you again next time. Like and share, et cetera, and thanks for being here. We'll see you next time. Savas, go to scottfox.com. There's a conflict or the Startup Council website. There are contact forms there. I don't give out my personal email address. Cool. Nice to meet you all. Hope to see you again. Thanks for watching.